Hello and welcome to the Accounts Rules Queries, part of our virtual compliance conference for compliance officers this week. A very warm welcome. I'm sure this will be a very well attended session. It was in the face-to-face session that we recently had. I'm Patrick Bolster. I'm the Deputy Executive Director of Resources at the SRA. Now, you may now be familiar with how our webinars work, but just in case, a little recap, or for those that are new to it, I'll tell you how it works. We'll try and answer your questions as we go through the webinar. This stream will be available on catch-up along with any slides and links to relevant web pages, and these can be found on the events section of our website. Feel free to share with colleagues, and we know that is already happening, for which thank you. The Accounts Rules session is one we run every year at this conference, so some of you may have seen how it works before. But if you're joining us for the first time, here's how it will be. In this session, we'll be looking at the practical issues and questions regarding how to comply with our accounts rules. To help us discuss the issues, we have a panel of experts who work with law firms on a day-to-day basis on just these issues. I've got some initial questions for our panelists based on the most common queries we hear at the SRA. We'll then open the floor to your questions, and we've already had some questions sent in advance, so thank you for those, and we'll be picking those up. You can submit live questions by clicking on the question link below this video. You can include your name with questions, but you can also do it anonymously if you so choose. Before we begin, I would just say that this session is about helping you to comply with the current accounts rules in the here and now. You may be aware that we're engaged in an ongoing review about the future of consumer protection arrangements. That review is looking at issues including the rules around client money, the approach to accountants' reports, how the different roles and responsibilities within a firm work. We won't be covering these issues in this session, but we will be addressing them elsewhere, as you'd expect. So to our panel, we have Ian Johnston, who is a council member of the ILFM, the Institute of Legal and Financial Management, and a reporting accountant in the legal team at Hazelwoods. He advises a portfolio of law firms on regulatory and compliance matters. Ian was awarded an honorary fellowship by the ILFM in December 2024 in recognition of his contributions to finance and management in the legal sector. We also have Ross Prince, who is a partner within the professional practice group at Crowe LLP. He has over 20 years of experience working with law firms as a reporting accountant and statutory auditor, and provides wider accounting, management, training and compliance support to COLPs, COFAs and senior leadership teams. We also have Jane Allen and Sarah Bevan, who are both managers in our ethics guidance team here at the SRA, and we will turn to them if we need clarification on any specific rules. So I get to ask the first questions. First, turning to Ian. You work with and advise firms on a day-to-day basis regarding financial compliance issues. Every year is different. What are you hearing from the ILFM's members as the current hot topics?
Thank you very much, Patrick. Hello. So this is not just for my ILFM members, but for my clients with Hazelwoods as well. There have been lots of really important things that firms have been trying to get to grips with. Firstly, there's client interest, how important it is to a lot of firms. There's obviously been a lot of debate around the future of client money and what's going to happen to client interest. I'm not going to get into that too much now, but I think that firms are feeling the heat a little bit more on this one because they assume that everybody, including the SRA, paying close attention to it. And so they're revisiting their interest policies, making absolutely sure that they can stand up to scrutiny. They're giving a fair outcome to their clients. And when it comes to fair, I'm still getting lots of questions around the mechanics of interest policies, so the rates they should be paying over to the clients, what the de minimis should be set at. And it probably feels strange referring to it as a hot topic still, because these questions have been going around for as long as I can remember. But I'm hearing a lot more of it now because I think people are expecting the SRA to be looking at this more closely. And on the topic of client interest, we're seeing firms really trying to understand what drives their profitability. So when it comes, where that profit comes from, making sure that the underlying quality of the PEP is good and that they've got a really strong understanding of their financial stability. Because if we're all understanding the SRA's and the LSB's thoughts on this, there's going to be more focus on financial stability pretty soon too. There are the usual offenders too, those questions about residual balances. They never seem to go away. I'm sure we're going to talk more about that today, but I think the SRA's direction of travel is towards tougher compliance on things like residuals, banking facilities, and so they've moved back up the risk ladder again. Clearly, everybody wants me to dust down my crystal ball. They want me to tell them what's going to happen in the budget. There's lots of law firms, lots of accountants keeping their eyes on this, especially around those possible changes to employers' national insurance on LLP partners' profits. Now, I've been asked by a few firms whether they should be looking at full incorporation into a limited company, or reversing back out of an LLP into an unincorporated partnership to protect themselves. I think we probably need to cool down a bit, just need to wait and see and not take any knee-jerk actions that we end up regretting. There's also the Mazur versus Charles Russell case a few weeks ago. That's still eating up a lot of headlines. A lot of my clients aren't concerned at all about it. A lot of them do feel impacted. It's potentially a game changer for those that are impacted, but I believe that Silex has just been given the green light by the LSB so that their members can fast track obtaining their litigation rights. So hopefully that's one that's going to go away fairly soon. So I guess when I stop and reflect on that question, it occurs to me just how much turbulence there is in the financial and compliance world at the moment, and just how much there is to navigate. And one final point I just want to mention, I do also write the Law Society's annual financial benchmarking survey. So I'm going to officially be reporting on most of these topics over the next few months. So we should have a clearer picture over the mood of the sector generally. So that's what I'm seeing. Thank you.
Thanks very much, Ian. Quite a few hot topics in quite a turbulent environment, as you say. So let's move to one of the topics. A topic we do get a lot of questions on at the SRA is accountants' reports. When are they needed? We get asked. When or why might they be qualified? And if they are qualified, what does that mean? So Ross, can I turn to you, please? Is this an issue you come across in your work? And what are the most common challenges or questions that firms bring up?
Yeah, thanks, Patrick, and good afternoon, everyone. When is an accountant's report needed? I mean, quite simply, if a firm is holding client money and doesn't meet the exemptions criteria, then you will need to commission an accountant's report. So effectively, that series of tests that your reporting accountant will undertake to see if you're compliant with the accounts rules. I think in terms of, do we have challenges, do we have questions from clients, whether they need to prepare a report? For the vast majority, this is a well-trodden path. So it's usually those firms who are perhaps entering new operations. Perhaps they're an overseas firm who are just setting up in England and Wales for the first time, or those firms who are bouncing in and around the de minimis levels for holding client money. So typically those are the kind of firms where I think they need a little bit more guidance and usually a little bit more help. The qualification question is quite an interesting one. So the fundamental principle, I guess, around when is a report qualified comes down to protection of client and third-party money. So I think it's quite interesting if we look back over history that historically the accounts rules were very prescriptive in their nature. So I think those of us that have been involved in this sector for a long time will be very aware that rules were breached. It was a very binary outcome, and that would result in qualified accountants' reports. Inevitably, that resulted in lots and lots and lots of qualified accountants' reports, potentially for relatively trivial reasons when you're operating a rules-based approach. As we move to an outcomes-based approach, it became much more subjective as to when should an accountant's report be qualified. And fundamentally, this comes down to, has there been really a loss to client money, a loss to third-party funds, or significant risk of loss to those funds? And that is quite subjective. I think it's probably quite important to raise a point here for COFAs and managers in law firms that although this feels like an annual thing, it feels like something your reporting accountant should be dealing with, don't forget that all through the year you'll be collecting breaches of accounts rules. You'll be making judgments on where things perhaps haven't gone right in the year. And you should be making a judgment call as well on whether you've had a serious breach of rules and whether you need to self-report under the code of conduct. So this shouldn't be things which become a surprise at year end, I guess. It's an ongoing monitoring and internal process as much as it is for your reporting accountant. In terms of the kind of things that we see, I mean, typically when we qualify audit reports, and I must point out here, this is a minority. You know, the vast majority of firms, for the vast majority of the time, are compliant. So, you know, we're talking typically for us, I think it's around maybe 5% of our accountants' reports may be qualified. That goes up and down depending on the year. And typically, that will be for things around reconciliations where there's been a lack of care in terms of the preparation, the review, the authorization of the client money reconciliation. That's a key control for all law firms. The operation of banking facilities, which I've no doubt we'll probably discuss in a little bit more detail. Things like suspense accounts where they're being used in excess and probably not in the spirit of how they should be. So generally speaking, the qualification is all about systemic failure usually, or whether there is a serious risk of loss of client money.
Great, thanks very much, Ross. That's very helpful. I'm going to turn to Jane. Could you explain what the rules say about when you should get a report and what you need to do if it's qualified?
Well, hi everybody. Yes, so unless a firm is exempt, they will need to obtain an accountant's report if they hold or receive client money, if they operate a joint account, or they operate a client's own account as signatory. So most of you attending this today, I think, will have to obtain an accountant's report. And it's really important that you do that quickly as soon as your accounting year ends, because that is the time limit. So if your accounting year ends, you've got 6 months with which to obtain your report. But if it is qualified, then you will have an obligation to send it in to the SRA, and you will want time to ask your accountant to prepare the report, to go through the report with them, particularly if it is qualified, and then have time to submit it within that 6-month window. And this is particularly important that you get your timing right, because the rules do not allow for an extension of time. So if you're late submitting your report because it's qualified, then you will be in breach of the accounts rules. We do have the power to ask for accountants' reports in other circumstances, and so that might be if your firm has closed, or it ceased to hold or receive client money, or if we believe it to be in the public interest. Now, just for you who haven't been in a position where you've had to submit a qualified report to us, if you do find yourself in that position in the future, you would need to do it through your firm's MySRA account, and it will go through to our notifications team, who will then pass it on to our forensic investigation team to look at.
Thanks, Jane. Now, you intriguingly mentioned unless exempt. Could you explain the exemptions that exist, please?
Yes, of course. So a firm can be exempt if the only money they hold or receive is from the legal aid agency, or if the maximum amount that they receive is under £250,000, and on their reconciliations, so their monthly reconciliations, there is an average of £10,000 or less. Now, that can be quite complicated for a firm to work out, and some years they might be within that exemption, but other years they may float into having more money than that, so they will have to submit an accountant's report. So it's particularly important that they do liaise with their accountant about this, so that they know when they have an obligation to submit a report to us. You know, trying to work it out is actually very complicated, and we do have a guidance note that will assist, and it's called Accountants' Reports and the Exemption to Obtain One. That should be helpful.
Thank you very much. Right, let's move on to moving of client money. Firms being asked by clients to hold or transfer money on their behalf. These requests can involve proposed arrangements the firm has not had to deal with before. So we have questions of compliance arising. Ross, from the firm perspective, how do you deal with those situations? Because you have the client relationship and the need to be compliant.
Yeah, I think let's just stick with the first principle. So you can only hold client money and transact client money when it's in effectively direct proximity to a transaction which you're advising on. So in terms of the big danger here, I suppose, fundamentally comes down to the default nature, I think, of fee earners who want to help. So particularly in the private client space, over time, there has been an evolution, I think, of what is expected and what is routine activity for a solicitor, for a fee earner, and what is now a real emphasis on the regulated service provided. And the rules are now really quite more defined around the kind of monies that you can hold in respect of that regulated service and the kind of transactions that you should be dealing with. I think the big danger here is, a big one is scope creep. So where we see issues will often be around a solicitor who's engaged in an original matter, could be perhaps, I don't know, let's say a purchase of a business. And then the scope creep as that matter progresses, where the client will then potentially try and direct funds or wish for payments to be made in respect of, say, an additional on purchase of plant and machinery. So I think fee earners particularly need to be very aware of scope creep away from the original engagement. Other things like paying VAT to third-party agents on behalf of the client. And in particular, I guess in the sort of the smaller end of corporate business, where you have owner-managed businesses, where you're dealing with a direct shareholder, you may be engaged with one or the other, the individual or the corporate entity, and not blurring the lines between those, and being advised by the client to direct payments potentially to one of their corporate vehicles or to them personally when you shouldn't, is something that I think all fee earners need to be aware of. What's quite pleasing, I think, when you see a good healthy finance function, a good compliance function, these points will get raised by fee earners as they wish to help clients, and we do see that the accounts teams will push back and say that's not compatible with the rules, and you will need to go away and have a slightly difficult conversation with your client. But I just think it's one of those areas that has definitely changed in my 20 years of working with law firms over what is expected from a solicitor.
Thanks very much, Ross. And in this arena, the use of a client account as a banking facility, so which falls within Rule 3.3, that's a major cause for concern. So Ian, how are you advising your law firm clients when they have concerns in this area?
Well, a lot of it really echoes what Ross has just been saying. I think the first thing that I say to all of my clients is go and read the case studies on the SRA's website. They're not hard to find. All you need to do is Google SRA banking facilities case studies, and it takes you straight there. There are a few more than there used to be. I know that. There used to be about 8 or 9. I think we're up to about 15 or 16 now. But I think they're really helpful. They don't take long to read at all. I know they can't cover absolutely every eventuality, but they do give it a fair shot. Should say there are still some gaps that need to be filled in those case studies. My experience, the biggest gap is around something that Ross was just talking about, where you've got client-to-client transfers between related companies. And that there are issues, potential issues there. Hopefully we're going to see more case studies coming up. Hopefully we're going to see these case studies as being something like a dynamic resource that gets added to or tweaked as we go along. I'm also advising firms not to force their own interpretation of the rules just because it fits their own narrative. So by that, I mean, if something doesn't feel correct, then it probably isn't. You know, if you've got to spend ages justifying why you're holding on to client money, why you're letting that money pass through your client account, then chances are you probably shouldn't be letting that happen. I think there's a bit of a blurring between doing something solely for your client's convenience and doing something because it's legally correct and integral to your service. So as an outsider, you know, as a reporting accountant, it's usually pretty obvious to me when a firm's letting a client use the client account simply because it's easier to do that than handle the money themselves. But again, just echoing what Ross said, it's possibly not as easy for the lawyer themselves to see that, especially if they've been acting for a client for a long time. So I guess I always advise clients to stand back. When I say clients, I mean law firms. I advise them to stand back once in a while, try to put their auditor's hat on. ask the question, am I going to get quizzed about this transaction by my own auditors? Because if the answer's yeah, possibly I might, then I would say they need to think twice about it. And of course, I always say, if in doubt, reach out to your auditors. We don't bite. We're usually pretty happy to give an uncoloured view. The other thing I try to impress on law firms is that holding on to client money shouldn't be a good thing by default. So, for a start, the SRA has issued warning notices by the bucket load on this. So that should give you an idea of how they feel about it. So I say treat client money like a hot potato. Try to make sure you don't hold on to it for a minute longer than you have to. So, apart from the fact that client money can easily turn into a residual balance without even noticing, it can play havoc with things like your PI premiums. And speaking as an accountant, there are lots of us that won't go anywhere near client money for that exact reason. Now, I accept there are nuances for law firms. I can't cover all of them in the few minutes I've got here. But if you start from a position of not actually wanting that money anywhere near your client's account, then at least you can start from a position of questioning, why, rather than idly wandering into a problem. And I think the final point I want to say, I always tell firms, don't be pressured by clients when handling client money. If they're putting pressure on you to do something and it doesn't feel okay, and you've got to ask the question, then it's very rarely coming from a positive place, and that should trigger alarm bells straight away. So yeah, there's a lot I tell my clients, and unfortunately, not all of it is very positive. But yeah, I think that's my point on that one.
Thanks, Ian. Some great advice in there. And as a former auditor, the bit about, auditors always appreciate clients who pick up the phone and want to check things. It always builds a lot of confidence. So that is an additional consideration. Thank you. Jane, can I turn back to you, please? What does Rule 3.3 tell us about use of the client account as a banking facility?
It means that you can't use your client account for anything other than for regulated services. So payments into a client account and transfers through and out of should be in respect of a proper service that you are providing. Now, in ethics, we discuss 3.3 queries quite a lot, and there's some practical guidance that we think we can give to solicitors when they're faced with a 3.3 issue. And the first is to consider where there's a reasonable connection or nexus with the regulated service that you're providing. And if you can't find that, then refuse to transfer or accept that money. As Ian says, you don't have to say yes to your client all the time. And I want to echo again what Ian says, which is what we say a lot in ethics, is read the warning notices, read the case studies on a regular basis, get your staff to do the same, so that you're constantly reminded of what is and is not acceptable. Some examples of what would not be acceptable would be for you to agree to allow your client to keep his funds in your client account just so that he gets or she gets a better preferential rate of interest. Transferring funds to third parties when it's not at all connected with the regulated service that you're actually acting on, or acting as a financial intermediary where you're not providing a regulated service. What we've found in ethics on the advice line, and we get calls about this every day, is that 3.3 problems tend to arise at the 11th hour. And I think firms are constantly having to think ahead and think of ways that they can try and nip these in the bud, so that it doesn't disrupt the service that they're trying to provide to their clients. And I think the best way of doing that is to talk to your client about it at an early stage. At the first appointment, you've got to discuss the nature of the retainer with them. Discuss with the client what will happen with their money during and after the transaction. And then, just check with them that they do actually have a bank account that you can refer money and transfer money 2, think about whether you can put something in your terms and conditions that flags up that you will only ever normally transfer funds back to your client. That might be something that you would find helpful to refer the client back to at a later date if he's trying to push you to do something that you're not happy with. And always be aware of warning signs. Is there a reason why he or she is asking me to do this? Could there be money laundering issues, insolvency, benefit, or tax evasion? You know, just have a think about it and make sure that you're truly comfortable. The ethics advice obviously is always happy to discuss these matters with you. We very often can't say, yes, that's fine. We don't provide safe harbour guidance. But what we can do is discuss the matter with you and perhaps think of additional questions for you to ask the client that you haven't thought of yourself. And we have a guidance team meeting daily. So if we're not sure about something, then we can take it to our teams. But if you're wanting a yes or no answer, I'm afraid we can only give you factors to consider, and then it will be a matter for you to think about your decision making and your judgment, and actually put that on paper so that you comply with your record keeping obligations in 2.2 of the code.
Thanks very much, Jane. Now let's turn to the issue of residual balances. We always consider that every year at these conferences. It's an example of an area where it's vital to have really clear communication with clients, something Jane's touched on. So I'll turn to Ian first and then Ross. When would you advise those conversations should take place?
I think I touched on this when I talked about banking facilities, but ideally conversations, well, communication should be throughout with all of this. Residual balances tend to turn into a problem when communication just isn't there, or there's been a break, and trying to resume communication becomes really, really difficult. To me, setting out the boundaries should really start before you receive any money from clients. So I've said it already, that there's a risk here that firms idly wander into problems with residual balances rule 2.5 or banking facilities rule 3.3. The two are very, very connected to me, and so being clear with the client at the start is really, really important. When it comes to the communication, though, further down the line, it's always broadly the same. Don't bury your head in the sand. Don't let balances build up. So, make sure that you're reviewing all potential balances regularly and communicate with the client as soon as it becomes clear that there's money that firms shouldn't be holding. Firms should make it their policy at the engagement stage to get bank details from the client and make sure the client understands that as soon as the matter finishes, any money held is going straight back to that account. And then having conversations not just with clients, but having conversations with fee earners as well. That's really important, and making sure that they all understand that the importance of having bulletproof file closure procedures, where files have to be closed, they've got to be cleared, all of the money's got to be returned to the clients, making sure that it's all archived immediately that they finish, and making that quite a strict part of the process. What about you, Ross?
Yeah, I'd echo a lot of what you said there, Ian. I think from a reporting accounting point of view, as we know, you're looking really for active resolution of these things. So there are legacy issues. Well, this is an area we've been talking about for a long time, but you can pick up on historic balances. It may be you've done an acquisition, there might have been a merger, and you inherit some of these things. And from our point of view, we want to see that there's an active plan to deal with the historic stuff, and really a kind of a priority-based plan, which focuses on perhaps some of the largest balances or maybe the most vulnerable clients first. So I think there's a definite element with residual balances that there's almost dealing with the old, the legacy problems, and there's preventing the new. And I dare say everyone here, we can all agree that a sort of a robust file closure process, not holding on to onto funds at the end, and there should be no need for any new residual balances to be arising these days. I think on that when you start root causing, or why does this stuff happen? Fundamentally, fee earners solicitors are busy people. You get to the end of that one matter and already like you're into probably a load of other matters, and you've got you're deep in the middle of transactions where clients are chasing you. I think it's really important that firms develop that culture and that those systems where it can be the accounts team, it can be compliance teams who are being that voice to put the exception reporting up and go, this has been inactive for a while now, how are we dealing with it? Having some KPIs around, we shouldn't have inactive ledgers open for more than X amount of time, whatever fits your firm's policy, and really embedding that into the culture. And that's important from a compliance point of view, but it's also commercially important as well. I think the hidden cost of dealing with residual balances is probably something which goes unseen. If you applied a charge out rate and the amount of time dealing with these things and put a pound cost on it to your firm, I think you'd be quite shocked at the cost of dealing with the residual stuff, particularly when it's all avoidable if it gets dealt with at the time. I think just as a quick tip at the end, accounts teams are really instrumental in this, but they're not the complete answer. Fee earners frequently have to take responsibility for dealing with some of the more tricky older stuff, but perhaps at the smaller end, delegated authority to accounts and finance teams and compliance teams can be quite helpful. So yeah, it's there's no need, I think, now for us to be developing more of these as we go forward.
Thanks, Ross. That's really helpful. And I was for 4 years the financial controller of a large law firm, and you're reminding me of just how key culture is. What we're talking about isn't admin, it's the internal control bedrock for a law firm. So yes, I very much underline what you've said. Thank you. I'm going to turn to my colleague Sarah now. When we're talking about balances, the sum can be very large or relatively small. Does the amount of money that remains in the client account impact what approaches should be taken?
Thank you. Yes, I think it probably does, because it depends also on how long the firm has had that money for, whether they have a file, whether they can trace it, and what the reason is behind it. Because I think everybody's touched on the point is this shouldn't be happening in the first place. If firms comply with Rule 2.5, return the money to the client promptly as soon as the retainer has come to an end. So it shouldn't be there with residual balances that are historical, because the file in most cases have probably been closed, shouldn't be closed. It should, even before they get to the point of trying to close the file, they need to consider having policies and procedures in place so that when these balances arise, that they're checked on a regular basis between maybe the accounts team and the fee earners in question, and maybe have systems in place that they check up on a regular basis with the fee earners before it gets to the point of file closure. So there are different methods of trying to return the money to the client, because the longer they leave it, the problem is the client may have disappeared, not communicating, they may have passed away, and that's difficulty in those circumstances. But there's a lot of free information you can obtain from internet searches. You can do social media, and one of the ones that we recommend is the Department of Work and Pension letter forwarding service, and this can trace somebody to see whether or not they're still, at their address, and they can take the money back. And that's what it's about. It's about returning the money to the client because it's client money. It's not about, trying to resolve the issue in a situation of making an application to us, because what we would expect the firms to take is proportionate steps, and the steps have to be proportionate to the size and the amount and how long they've had it. So there is, information that you can get out there, but as both Ross and Ian have touched on, it can be pretty expensive several years down the line with fee earners who have finished that file, they've parked that file, and, the interest is lost. but then you have people that are in the finance team who have got no idea who the client is. No, they're contacting the client. They may have difficulties. They don't understand sometimes why they're holding the money, and that's the problem. It needs to be done, as soon as possible, and so they need systems in place to say, why are we not returning this promptly? What's the reason we're still holding this money? And that needs to be done early on.
Thanks very much, Sarah. Right, we're going to open up to the questions that you've provided, for many of you on the call. So I'm going to start with one we had even before the call started. So the question goes, I have seen many firms using the very old interest rules of not paying interest unless it's £1,000 over 10 weeks, etc. And also companies having a minimum of £200 across the board, even private client work. Would you say that firms operating under those calculations are indeed fair? And would you expect the auditing accounting to flag this? Ian, I'm going to come to you on that one.
Okay, that's a tough one. There's quite a bit to unpick with that. I would say, first of all, would you expect the auditing accountant to flag this? One thing to be aware of, actually, that the interest rule is actually outside the scope of the work that we do. So with the accountants reports that we prepare, it's specifically excluded from what we do. So we would flag it if we noted it, but there's no obligation in our work to do that. So there's a chance it wouldn't get picked up. Just looking at it from that angle. Now, looking at the de minimis, £200 plus across the board, it feels a bit toppy. I reckon Ross might pitch in on this one as well if I ask him, but we see most firms going for about £50. That seems to be the norm. Some firms push it to between £50 and £100. I would say that they are ever so slight outliers, but still within the realms of what we see. £200 does feel a bit toppy. Now, that not paying interest unless it's £1,000 or over, yeah, I get that. That's the old matrix that used to be in the 1997 rules or whatever they were. I wouldn't recommend that you hardwire that into your policy, because that's kind of what the de minimis is there to pick up. So yeah, it feels a little bit on the edge. What about you, Ross? What do you think?
Yeah, pretty consistent with what you're seeing, to be honest. We see a lot of £50 de minimis, some up to 75 and up to 100. Some firms are taking a view that they will treat corporate clients with a different policy to private clients, and perhaps with a slightly lower de minimis for private clients. We're seeing a little bit of that. I think from a reporting accountant point of view, and I'm sure, Ian, you've been through this as well, when it comes to subjective calls, such as, is client money being put at risk? We're not too bad at that. I think for everyone, this concept of what is fair is such a subjective area that you see a huge spectrum of outcomes here. So within the client base, within my contact base, we see everything from clients who pay everything 100% of interest back to clients. Admittedly, that is rare. And then down at the other end, some quite, I would guess, what could be seen as aggressive interest policies. The vast majority of firms, in my experience, are looking at their own headline bank and their rate on a no-notice account and applying that as an appropriate rate, or maybe taking a basket of potentially high street banks and taking an average of those rates in terms of the amounts they're paying to clients. So yeah, this is an area where there's a lot of outcomes. I think it will continue to be a hot topic for the foreseeable future, I think.
Right, good prophecy there. Thank you, Ross. Can I go perhaps a much simpler one and come back to you, Ian? Question: if we have a residual client balance on a file, example £1, and we make contact with the client and the client asks us to send it to charity rather than send it back to them, can we do this?
Yeah.
Thought you'd say that.
How's that? Yes, yeah. I don't think it's
succinct,
that
very clear answer.
Yeah.
Next one. I have a newly established firm and don't handle much client money. How will I know if I need to start submitting accountants reports? Sarah, can I come to you on that one, please?
Yes, they don't need to submit an accountant's report unless it's qualified to us. But what they need to consider is whether or not they fall within one of the exemptions that Jane discussed earlier under Rule 12.2, and whether or not they need to operate a client account. And we've got guidance note on the website that sets out, do I need to operate a client account? And there's also one where you're just taking your costs. So it's client money, but it may be the case you're taking money on account of costs and you don't need to operate a client account in certain circumstances. So it might be useful to look at that in the first place.
Okay, thank you. Next question. Our client is a special purpose vehicle that can't open its own bank account. Can we remit the proceeds from the sale of a property to a connected entity on instructions of the clients? Jane, can I come to you on that one, please?
Yes. You need to find out a lot of information really about the relationship between the companies and the regulated service that you were providing. This ultimately it will be a judgment decision for you, and you would need to be satisfied that there is a sufficient nexus and connection that I was discussing a little earlier on. It will be really important here that your record keeping is really detailed, because if there's no real connection between the companies at all, then that's going to be very, very difficult. But and you also need to find out why they can't open a bank account. Can they open a bank account? They're just saying that they can't, or are they really struggling to do so? Because there are some internet banks out there who will open bank accounts for them. It's really for the solicitor to think about the relationship between the parties, the relationship with the regulated service that they're providing, and whether there is any other sort of alternative, and make a detailed note as to their reasons why they decide one way or the other. I can't really give a yes or no answer for this, I'm afraid. I think it's down to the firm's investigation, asking questions of the client, and being satisfied that it's reasonable in all the circumstances for that payment to be made to that company.
Thanks very much, Jane. Right, Ross, next one for you, please. We recently innocently paid a check into office account that was meant to be paid into client account. As soon as the check cleared, the funds were transferred and no loss occurred. Is this something that we should be reporting to the SRA?
Okay, so mistakes happen. Fundamentally, the whether to decide whether to report to the SRA is, of course, the firm's decision, and I'll come on to some reporting on that and some documentation which may be helpful. I think mistakes do happen. You have to start off with, was there a loss to client? Was there a significant risk of a loss to client's money? And is this a systemic problem? So if we just break those down into pieces. So if you innocently paid a check into the business account, into office account, it's cleared and then immediately transferred back, and what you were able to do so, has there been a loss to client? No. Was there a risk? Probably not. I will caveat that by saying that there is always a duty to remedy breaches, and this is quite an important point. So Ian touched on the financial stability of firms, I think, when we started this session. I think if something goes wrong and the amount of client money involved is such that you have more than adequate resources within the business account to put that right quickly, that's very different to if you're in a position where something goes wrong and you're not able to remedy that with your own funds, which is obviously something you should do from a rules point of view. So I think that's all relevant to this case particularly. It sounds like this is a relatively non-serious breach. Clearly it should make its way onto the breach register. And I would just add that just recording the breach is helpful. Yeah, it's something you need to do as a firm, and particularly for the COFA to review. But equally, it's quite helpful to make a judgment call, and we always recommend to clients that you document the reasons that you've taken to either report or not report around an issue. And I think that's helpful, particularly if there's any follow-up later on, that you can demonstrate your thinking and your process, and that you've taken it seriously. So I think the key point on all of this documentation is how will you identify if this is a systemic problem? If it happens once, that's one thing. If it keeps happening, then what's the root cause for that? And have you actually got a breakdown in of system of your control environment? So hope that helps.
Thanks, great advice, Ross. Thank you very much. Let's come to Ian now, the next one. They're coming thick and fast. If dealing with a residual balance below £500 and the client asks for it to be sent to charity, is this considered acting as a banking facility?
I sort of wish I hadn't answered the last question with just a yes, because I suppose it opened up the floor for further questions like that. 500, but below £500, a client asks for it to be sent to charity. Look, as long as you don't suspect that there is some specific an unsavoury reason that they're asking you to pay that to charity, and I can't think what that would be, then I think that's absolutely fine. As you start getting up the scale, you know, if that £500 became £5,000, then you would need to question why they don't want the money themselves. But I would say for balances that don't require SRA approval first to pay them over, then yeah, I think you just go ahead and do it.
Okay, thank you very much. Right, next one for Sarah. A Rule 3.3 query often arising is how do we return funds to a client group of companies when the client entity has closed its bank account or has been dissolved and wants the firm to pay a related entity's account? What should we do?
Okay, I think we can deal with this in two parts. I think the first part, if your client company is dissolved, then the money probably belongs to the Treasury solicitor bona vacantia. So you'd have to write to them to see if they want the money. So the fact is that they're in a group of companies would not allow you to remove that money if it belongs to that individual company who is the client. And I think Jane has already touched on an earlier question in connection with the second part where it's a group of companies. Why would you be sending it if the company is still an active company? Imagine it's an active company, not a dissolved one. Why would you be sending it to another company? What's the reason? Why haven't they got a bank account? And I think these are all questions to be asked. You know, is there a reason behind it? Is it to avoid tax? You know, is there any other implications? So I think you'd have to ask a lot more questions before you transfer that money that belongs to one company to another company.
Thank you. Right, I've got an interesting one here that is probably for one of our two reporting accountants. I think I'll come to you, Ross. In some cases, we accept fees for professional services in cash as long as it is within the overall limit of £1,000. It is client money until the work is completed and billed, but to bank this cash in the client account requires a 20-mile round trip and staffing hours. We could deposit this cash in office accounts. The physical bank branch is much nearer, and then transfer this straight to the client account and keep all the ledger and information updated. However, our accountant's view is this would not be a correct course and the cash has to be deposited in client account directly. What's the best way to proceed, please?
I won't cover the AML points around cash. I'll assume that that's covered elsewhere and you're happy with the provenance of funds. I have some sympathy here, but I think I'm with your reporting accountant. So really, unless that's a mixed receipt and contains business funds and client funds, then ultimately that's a payment on account, and really it should be deposited within a client account as soon as possible. So yes, aside from moving, I'm not sure I can give you an easy answer to that one, I'm afraid.
Yeah, no, thank you. And I think that just illustrates that we'll tend to find a consensus amongst the reporting accountant community, I would hope. That's evidence of that. Right, next one I've got, and I'll go to Jane on this one. With residual balances, could we set a de minimis to be paid to charity at matter close in the engagement letter based on client materiality?
No, I don't think you can. Client money belongs to the client and it doesn't belong to the firm. So whilst, as we've already discussed, at the end of a retainer, if you've just got £1, you may do that on the client's instructions. to put it actually in your terms of business and your engagement letter. Ethics is of the view that you should not do that, because under 2.5, client money should be returned promptly to the client. There's a distinction between the two.
Okay, thank you. And the next one I'm going to come to Sarah on. Ryan asks, can we hold money if there is a longer expected time gap between a residential sale and purchase? What would be a reasonable time frame?
Okay, well, we can't give comfort with regards to what a reasonable time frame would be, but it would be, say, for example, if you've got instructions from the client and you've got the estate agents have written in and you know that the purchase is there and you're doing the work and you're going to exchange contracts, that would probably be okay. But that's taken differently. Say, for example, if the client says, I'm looking for a property, and you inadvertently end up holding the money for, say, 4 or 6 months, that wouldn't be appropriate. So there's no time frame that we can say, but it depends on how active that client is. And there is a risk that if you don't, then you may be holding some money that you shouldn't be holding. So it goes back to rule 2.5, return to the client promptly, especially now that we have internet banking. If you return it to the client and you're not going to exchange or complete for another 6 weeks, there's enough time for the client to send that money back to you. So I don't think we can be definitive on months. You've just got to consider at what stage that purchase is at.
Okay, thanks, Sarah. Right, I've got an interesting one coming to Ian. So we'll take a bit of reading out, but I think there'll be some value in that. So, anonymous one. I'm a newly appointed COFA and have recently discovered that back in 2008, the firm received a little over £14,000 from an unknown person. The previous COFA was unable to get any information about the source of funds. Extensive investigations could not find a home for the money. Both the SRA and the bank said we could not return the money as this would be classed as money laundering. The bank said it was common practice for criminals to send money to random accounts and hope it was sent back, thereby cleaning the funds. We still hold that money. What are my options for getting rid of it?
I think my answer is probably going to be quicker than the question on that one. I think really, and I might get shot down in flames by my SRA friends here, but this is one where you should be looking to donate that money to charity. Money going into the client account, sitting on suspense, and firms saying, well, we just need to return it back to the sender. Well, yeah, you've really got to give that some quite detailed thought, because this money laundering point is a live point. So I think you'd look to donate to charity. Obviously, it's £14,000. You're going to need the SRA's authorization to do it first, and that's why I think my SRA friends might be glaring at me now. But that would be a heck of an application. But I think that's the only way to go. Nothing else you can reasonably do with that.
Thanks very much, Ian. I didn't see either of them glaring, and I actually think I saw Sarah nodding. Sarah, can I come to you, or Jane? Yeah.
Yes. Sorry, go on, Jane. You go.
No, I was going to say yes. I agree with that, absolutely.
We do, yes. Make the
Okay.
application to us. Mm.
Right, absolute unanimity in the answer, so that's great. Right, then I've got one which I'll ask you about, Jane. If a client's residual balance is minimal, but the cost of tracing them is disproportionately high, what is the recommended course of action? And then notes, I believe our guidance does deal with that matter, but
yes. Well, that aside, I think we would only expect, if it's minimal, then obviously I'm assuming it's under £500. We would only expect you to take a course of action if it were cost effective for you to do so. Instructing an inquiry agent at £100 for a balance of only 20, of course, is disproportionate, and we wouldn't expect you to do that, no. In most cases, if you can think, if you've got a name and an address for the client, even if it's an old address, you can think about using the Department of Work and Pensions letter forwarding service. I believe that only costs, between £5 and £6. And that is something that we very often ask. I would say 99% of the applications that we receive to go away and do. So you can look at that. But there are also lots of free things that you could do, as Sarah indicated in her piece, such as doing a quick social media search and that sort of thing. But we wouldn't expect you to spend more than what the balance is worth itself. It is a general rule.
Yeah, that makes sense. Okay, probably quite an easy, quick one. I'll come to you, Sarah, on this one. In our immigration law practice, sometimes client money is in the client account longer than expected while applications are made. Should we worry about having these balances in the client account?
I don't think they should be worried because they've still got an underlying retainer. So it's a carrying on retainer, and it's quite common for you to have money on account. I think the risk is if the process isn't happening and you've got no instruction from the client, do you still have a retainer? Has the retainer come to an end? You know, failure of instructions, and then you would be returning the money or taking attempts to return the money back to the client. But I think as long as you've got that nexus and an underlying retainer, I don't think it's a problem.
Okay, thank you. Look, I think I'm going through and checking, but I think we've answered almost all of the questions. There was some straying into beyond the scope of this session, which I outlined at the start in terms of, you know, compliance with the current rules is the scope and not how things might be reshaped. So I think we're coming to a close there. What I will say is that we'll try to come back and review if there's any that we don't feel we have got to on that. Our intermediary, my colleague Lee, is just typing, so I'll just pause momentarily to see if there is a late entrant question that we can sneak in. No pressure, Lee, because there are 3 dots going up and down, a bit like you have in Teams chat for those that use that. No new questions. He was confirming no new questions, and I can wind things up. Therefore, I will move to the winding up stage very slickly. Thanks very much for that confirmation. So I'd like to thank our speakers, a great panel. You've been really informative and given really clear answers. Thank you, all 4 of you. Now, if you haven't had time to answer your questions, as I say, we will look through them all and double check, and we'll try and cover in future webinars and communications. We hope you found the webinar discussion useful. Please do make sure you complete the evaluation for the session. This can be found below this stream. I'm afraid we're the last of the virtual conference sessions. We always finish with a bang. Thank you if you've been with us for most of these, and do catch up with all our sessions via the on-demand service. So thank you very much again, and goodbye. Have a good rest of the day.